the enterprise platform designed as one system from the start, and the legacy processor extended over 3 decades. One lost 39% of its stock value in a single day while every merchant's transactions processed normally. The other had a merchant obtain a court order, forcing it to continue service through the end of a contract it wanted to exit. Adyen and Worldpay. One was founded in Amsterdam in 2006 by founders who had seen payment fragmentation firsthand. The other was founded in 1997 and has had 4 owners in 7 years. One has no documented merchant fund holds. The other holds funds past its own stated window. Both serve enterprise merchants across hundreds of countries. The horror stories reveal what each company is. Investor risk on one side, where the stock crashes but merchants are unaffected. Contractual entanglement on the other, where the contract designed to retain merchants ends up in court. Adyen was built as a single platform from the start. One integration for online, in-store, and mobile payments across every country and payment method. The co-founders came from a Dutch payment processor that had been acquired and saw the fragmentation global merchants suffered. The thesis was to eliminate it. The client roster validates the thesis. The largest streaming services, the largest ride-hailing platform, major restaurant and retail chains, all processed through the same single integration. The public offering in 2018 valued the company at approximately $7.1 billion. Revenue by the fiscal year ending 2025 reached $2.36 billion, with margins between 53% and 55%. The 2023 stock crash was a growth deceleration. Revenue grew 21%. The market expected more. 39% of the stock value was erased in one day. No merchant was affected, no transaction failed, no fund was held. The recovery through 2024 and 2025 was consistent. North America became the fastest growing region by the second half of 2023. The company that had never visibly stumbled in public stumbled, recovered, and resumed growth. The horror story was entirely an investor event. Worldpay was built over decades through acquisition, integration, and extension. Founded in 1997 as an online multi-currency processor associated with a major banking group, then acquired for $35 billion, spun off, sold to a private equity firm at $18.5 billion, and sold again to a competing payment technology company at $24.25 billion. 4 ownership changes in 7 years. Revenue of approximately $5.48 billion. 174 countries, 250 currencies. The merchant complaint record reflects the accumulated processes of a legacy operation. 3-year contracts with automatic renewal and early termination fees. Fund holds past the stated 120-day chargeback window. Billing charges continuing after account closure. Billing errors from 2022 unresolved in 2025. The designer brands case in January 2026, where a retailer obtained a court order forcing the processor to honor a contract it wanted to exit. The contract structure that locks merchants in also binds the processor. The ownership changes continued throughout, but the processing did not stop, and the merchant complaints did not change in character. The architecture comparison is the clearest distinction. Adyen designed one platform from one starting point. Every country, every payment method, every channel, through one integration. The data from online transactions informs the fraud scoring for in-store transactions. The reconciliation covers all channels in one view. Worldpay extended an existing architecture over decades, adding capabilities through acquisition and integration rather than a unified design. The developer experience reflects the difference. Adyen's programming interface is described as demanding but coherent. Worldpay's documentation reflects layers of accumulated integration. The contract comparison reflects different business philosophies. Adyen does not require long-term contractual commitments. The merchant relationship is maintained through product quality and service rather than termination penalties. Worldpay's standard contract runs 3 years with automatic renewal. The early termination fee is the mechanism that retains merchants. A merchant who signs without understanding the renewal clause may find that leaving costs more than the processing fees saved by switching. The pricing comparison uses the same underlying model. Both offer Interchange-Plus pricing. Both negotiate custom rates for large volume merchants. The transparency of the model is similar. The accessibility differs. Adyen's enterprise focus means the pricing conversation assumes a payments team. Worldpay's broader market reach means smaller merchants encounter the pricing without the expertise to model it effectively. Both platforms provide lower effective rates at high volume than the flat rate models the mobile-first platforms charge. Someone whose enterprise requires a unified payment platform across multiple countries, currencies, channels, and payment methods, who needs marketplace sub-merchant payouts, who has the technical resources for a demanding integration, and who does not want a long-term contractual commitment, should evaluate Adyen. The single platform architecture delivers its full value at enterprise scale. The absence of merchant fund hold complaints in the research record is a product quality signal. The integration requires significant technical investment. The fraud tooling optimizes approval rates at volumes where the difference between 97% and 99% represents material revenue. Someone whose enterprise operates at high volume across many countries, who values established institutional relationships and negotiated pricing, who has procurement and legal resources to navigate a multi-year contract, and whose primary requirement is processing scale rather than architectural elegance, should evaluate Worldpay. The geographic coverage across 174 countries and 250 currencies is the broadest in the comparison. The negotiated pricing at high volume can produce competitive rates. The contract should be reviewed carefully before signing. The termination clauses, the renewal terms, and the fee structure require legal attention that the mobile-first platforms do not demand. Someone choosing between them should compare the risk profiles. Adyen's risk is investor-facing. A stock crash that erased $13 billion in market value while merchants were unaffected. If the company's growth slows again, shareholders bear the consequence. The merchant relationship is unaffected by stock price movement. Worldpay's risk is merchant-facing. Fund holds past the stated window. Billing charges after closure, a contract structure that produced a court dispute. The merchant relationship carries friction that the processing infrastructure does not explain. The ownership stability comparison favors Adyen. The company has had the same leadership and ownership structure since its founding. The public listing in 2018 did not change the operational direction. Worldpay has had 4 owners in 7 years. Each ownership transition brought strategic realignment. The processing continued throughout. The strategic clarity did not. For an enterprise evaluating which platform to integrate deeply into its payment infrastructure, the stability of the provider's ownership and direction over the next 5 to 10 years is a relevant factor. The developer experience comparison favors Adyen. A platform designed as one system produces a coherent integration surface. A platform extended over decades produces a layered documentation surface that requires more adaptation. For development teams building payment integrations, the coherence of the programming interface affects the total cost of integration, maintenance, and future feature adoption. The fraud tooling comparison is close. Both platforms offer enterprise-grade fraud prevention. Adyen's approach uses artificial intelligence-driven risk scoring that improves with the volume of transactions processed across its platform. Worldpay's fraud stack is cited as a strength in independent reviews. At enterprise volume, both platforms provide fraud capabilities that the mobile-first platforms do not match. The enterprise platform, designed as one system from the start, and the legacy processor extended over 3 decades, serve the same market segment from different positions. One offers architectural coherence, contract flexibility, and a horror story that hits shareholders. The other offers established scale, negotiated pricing, and a horror story that hit a courtroom. For the enterprise merchant with the resources to evaluate both, the choice depends on whether the priority is a unified modern architecture or an established processing network with decades of institutional relationships. Both process payments at enterprise scale. The experience of being integrated with one is different from the experience of being contracted with the other. The processing works on both. Everything around the processing is where the differences live.